Okay, welcome everybody. This is Justin with Justin on Money. We got a lot to get into today, specifically around this fear about the U.S. debt, basically investors basically liquidating the U.S. debt, I should say. So we're going to get into some of this stuff, and I want to know what you guys think about what's going on currently with this supposed foreign U.S. sell-off of debt. Okay, if you've been online this week, you probably have seen the headlines. Okay, foreign investors are dumping U.S. Treasuries. Okay, Europe is abandoning U.S. debt. Okay, Davos, did you guys see anything? The dollar is about to collapse. Okay, we're going to slow this stuff down a little bit because when you actually look at the data, this story looks very different from how it's being presented. Okay, so I think we need to start with why this story spreads. Okay, yes, there's a lot going on, but stories like this spread because I think they combine three real things that we're seeing that are happening. Okay, political tension, okay, is one. Rising bond yields, number two. Okay, and a very small number of high-profile decisions, okay? You mix those together, and it feels like the system is just collapsing, breaking around you. But financial systems don't move on feelings, okay? They move on flows and scale and substitution. So I want to know what you guys think about everything that's happening. But we're going to start with what I think we should talk about scale, okay? The Danish pension fund, okay? Yes, a Danish pension fund announced it plans to exit U.S. Treasuries. Very dramatic sounding, right? Pension funds are huge monsters, okay? But in dollar terms, we're talking about hundreds of millions, I should say, okay? The U.S. Treasury market is over $27 trillion in size. That decision for that pension fund is politically meaningful and I think symbolically kind of interesting, but not systemically meaningful at all. I mean, markets don't collapse because one fund changes its mandate. And this is where the confusion can come in, okay? The data is everywhere. We can see, which we're going to pull up here, which Danish pension fund this was. But understand that no matter what, when we talk about hundreds of millions of dollars, we really have to wrap our heads around that is just really, it's just, what's the good word for this? Just tiny, okay, ant size compared to $27 trillion. So I think those things can be blown out of proportion, okay? They, like I said earlier, they collapse when buyers disappear everywhere, okay? And this is not where, or this is not what the data shows, okay? Foreign holders also are not a single actor, okay? So like, I think there's a mistake here that a lot of commentary is making, okay? Europe, Japan, foreign investors, okay, these are not single decision makers. Foreign holdings of treasuries are split across central banks, pension funds, insurers, dealers, banks. I mean, the list really goes on. You could even definitely include reserve managers in there. But when one group reduces exposure, another often increases it. Okay, so that's how deep markets work, and the treasury market is a deep market. Okay, but I've touched on this before about Japan. What do you guys think? Okay, I don't think this is some fire sale. Okay, I think yes, Japan yields have risen. Okay, and yes, of course, that changes initiatives. incentives. But when Japanese investors repatriate capital, they often hedge currency risk, not dump treasuries outright. Okay. And clearly, Japanese institutions, okay, they still need dollar assets. They still need duration. They still need liquidity. Okay. These are things that are needed. Okay. Rising domestic yields don't automatically mean that we need to abandon US debt. Okay. They mean rebalancing. Okay. So I don't think it's a panic fire sell for Japan. Okay. So let me know what you guys think. But why yields rising does not equal the dumping of treasuries. Okay. Let's be very clear about something. Higher yields do not mean no buyers. Okay. Higher yields mean the price adjusted. Okay. The market cleared. New buyers stepped in at a different level. Okay. That is how functioning markets work. If treasuries were truly being abandoned, I think you would see failed auctions. I think you would see persistent bid to cover ratio collapses. And I think funding market stress as well. We're not seeing any of that. Okay. And this ties in to this dollar weakening thing. This is all temporary, okay? Not terminal, like what's being said, okay? Yes, the dollar has softened recently, okay? Tariffs, all these other things can tie into this, but that happens during policy uncertainty, when people unwind positions. Short-term risk repricing is a huge one, okay? A weaker dollar over a few weeks is not evidence of de-dollarization. People get so mixed up in the day-to-day pricing, and it can really confuse people. If anything, periods of global stress historically increase demand for dollar liquidity, not reduce it. So I don't think that's any kind of ideology. Okay, that's structure, guys. So there's a lot to get into. Okay, but we need to talk about the Fed. You may hear claims that trust in the Federal Reserve is collapsing. And here's the reality. Okay, funding markets are functioning. Okay, treasury auctions are clearing. Swap lines remain active. Dollar funding remains dominant. Okay, trust isn't measured mostly by YouTube sentiment. Okay, it's measured by whether settlement still works. Okay. And right now it does. I mean, are you guys seeing something different? Because I'm not. Okay. Now we need to talk about the BIS. Okay. This is the Bank for International Settlements. Okay. This is like the central banks of banks. Okay. They have been very clear. Okay. Periods of fragmentation and geopolitical stress do not cause investors to abandon core settlement assets. Okay. They cause volatility. Okay. Repricing, temporary dislocations. There's a lot of good information on the BIS. Okay. I'll include some of those in the links, but they also reinforce the role of safe assets, that not erase them. Okay. The real risk. Now, this is important. None of this means there are no risks. Okay, that's not what I'm saying. The real risks are long-term fiscal sustainability, political volatility, okay, higher structural interest costs. And those matter over years, not weeks, okay? They show up slowly through budgets, growth, and policy choices, okay? Not through sudden treasury dumping, okay? I'm really interested to know what you guys think about what's going on, okay? So I'm going to close this out with saying, no, investors are not dumping US debt, okay? What I think we're seeing is repricing, rebalancing, and normal market stress during periods of uncertainty. It's uncertain right now, okay? It's very uncomfortable. It's a really wild time we live in today, okay? But guys, keep in mind, it's not collapse. Okay, the fastest way to get confused about markets is to confuse price movement with system failure. Don't fall into it, okay? They are not the same thing, okay? So, one other thing I'll say, okay, volatility tells you where opinions are changing. Settlement tells you whether the system still works. Right now, it does. So, thanks for being here today. Let me know what you guys think in the comments. What do you think about Japan dumping US debt? What are your concerns about monetary policy right now? What are your concerns about the economy right now? Let's touch on these subjects, and I will give my insight on this. I'm Justin, and thanks for being here.